Hey everybody, this is Brant from Wolf on Wall Street Trade, soon to move to our new home, thetechnicaltake.net. You can check it out, but you can only subscribe at Wolf on Wall Street Trade right now, and you are locked in at 2008 rates. Anyway, so interesting week. The main things, earnings, of course. We're still in earnings season. The Fed, with the FOMC, raised 25 basis points as expected, and something unexpected from the Bank of Japan that affected U.S. markets pretty substantially, and a really interesting price development in the S&P 500 that you need to see. Anyway, let's jump right in, take a look at an intraday chart of the S&P, and you can always see the time frame right up here. So this is a 10-minute chart of the S&P 500. This is a bullish ascending triangle, okay? It's a consolidation pattern. It has a very bullish bias, and we did get a breakout from it this week, right up to 4,600, and then we got a failure of this pattern all in the same day. This is going to be an important one to watch. I'm going to tell you what happened here. Okay, so we're looking at a daily chart now, the S&P 500, and notice this 4,600 level. That's where we've been kind of messing around this week. This is an interesting level because this is where we saw some toppy action right over here in December of 2021, right before we came into the bear market of 2022. You can see as prices break down, they bounce into that 4,600 area. We actually got a little bull flag here. It failed. Okay, so failed patterns often lead to fast price reversals, and that's what we see here. The bull flag failed. Here we are in our bear market. Here we are starting this new October base over here. Bull flags were running up. This, by the way, is 2 months of kind of lateral trade in earnings season. Very dull, so we're in earnings season again. Now, I just added a trend line over here at 4,500 because to me, that's actually a really important part of this toppy pattern over here. So when you have areas like this, they can be overhead supply. Now we're going to zoom in closer. Again, remember this 4,600 level, 4,500, 4,600, both important. So now we're looking at a daily chart of the S&P 500, just a little bit closer. You can see the 4,600 level right here. Down here is 4,500. So Thursday, this is a key reversal day. This is what is really important. So we look back at our whole trend from October lows, right? This whole rally. One of the primary things that you need to see for a key reversal to be effective is a strong uptrend before that, right? So key reversal day opens at a new high right over here, and then it closes below the prior day's close, and also usually it engulfs that entire candle. So a lot of people will recognize this as a bearish engulfing candle, but there's a few additional things that need to happen to make it a key reversal day, like that new high, and that's a 52-week new high. These are not common, but they are one of the most reliable chart patterns out there. Now, why it happened also plays into its importance. Real quickly, I had a few questions. So what would invalidate this key reversal day? A close above this high over here, and what would make it more probable is prices closing below this low over here. Now, I am not calling for a bear market or crash or anything like that. I'm saying this is a really important day to be keeping an eye on. So what actually happened to form this key reversal day? Let's take a quick look again at this 10-minute intraday chart. So here's the open above 4,600, important level, right? And then we get a little back test into 4,600 and a complete failure. What happened was the Bank of Japan, this is Thursday, by the way, so the Fed hiked 25 basis points over here, did nothing, didn't even violate this ascending triangle. The Bank of Japan floated like a trial balloon, and it came out from Nikkei, and they basically said that they might tweak yield curve control, YCC. Right now, the Bank of Japan will not let the 10-year JGB go over 0.5%. They'll intervene every time. So they were talking about adjusting that a little bit higher because right now Japan has the same inflation rate that the US has, but we have a 5.25 to 5.5% Fed funds rate, and they have got their 10-year pegged at 0.5%. So after we got this big key reversal day, and you can see how ugly it is, not only a key reversal, but also a failure over here. So failed breakouts often lead to fast reversals. This is the next day. So I want to show you what I wrote Thursday night for the subscribers. So what you're looking at is a section of my daily wrap for my subscribers, and I'm talking about what happened this day, this Thursday, right, with the Bank of Japan, BOJ. And this was a story that was floated a week ago in Bloomberg, and nobody took any notice. So what I wrote on Thursday night was Japan is the largest holder of U.S. Treasuries. So dumping JGBs, their treasuries, would suggest less demand for U.S. Treasuries to higher yields. The market is afraid of a global bond sell-off over this Bank of Japan yield control curve tweak. And what you saw today was a trial balloon. I go on to say, I don't know what's going to happen, but the Bank of Japan doesn't have a great reputation for following through on things. I said, if they do nothing, the next day, Friday, we may very well see yields retrace a large portion of today's move and send stocks higher. Regardless, I think some real damage was done on the charts. A key reversal day in the benchmark index is nothing to dismiss lightly. That forms our key reversal day. Here is Friday. It's just kind of an inside day, right? Not much happens. But because the Bank of Japan didn't really do that much, they basically said they're going to let it float, the JGBs float between 0.5% and 1%. 1% they will step in and intervene. And then anywhere in that range between 0.5% and 1%, it's up to them, their discretion, what time, when, where, how they'll do it. So the market felt a sigh of relief. It wasn't as bad as what they were thinking it could be here Thursday. But still, we do have this key reversal day on the chart. Now, I want to jump over to the NASDAQ 100 because that's been the index really that has led all of the rally for 2023 thus far. So remember, in 2022, NASDAQ was really the most hated index. And then as we came into 2023, here's where it really took over leadership. We see a big, huge bull flag over here. This is earnings season again, that kind of lateral sideways trade. Bull flag over here. Notice these two trend lines. This one is just an approximate 14,775, and the other one is right here at 15,550. I'm going to show you where these came from. And now we're looking at a daily chart. So it's very much like the S&P 500. This is the all-time record highs, okay, in 2021 before we went into the bear market and the Fed started hiking interest rates in March. But see what I'm seeing here. A little toppy formation right there and a larger toppy formation, this whole thing right here. So that is where these two trend lines come from. And that is why I have them marked on this chart, because I think they're really important, just like the two S&P ones. Now we're going to go back to an intraday chart and take a closer look again. Okay, now we're back to a 30-minute chart of the NASDAQ 100. This last bull flag, this is its measured move right here. I'm going to put a little pointer. NASDAQ basically hit that measured move, right? Really close to 16,000. Also, notice these two levels again, 15,500 and this other one over here that I just showed you on the daily chart. Since we hit this measured move, what is most probable to happen after you hit a measured move is that price consolidates. But what we've seen since this measured move was hit is a lot of volatility, not the typical lower volatility of a consolidation. So I want to show you one more thing. I'm just going to take off the trend lines here. And once I take off those trend lines, I think you can see it looks almost like there's like a little neckline, maybe an early toppy formation forming over in here. To me, it's just way too volatile for a typical consolidation or what we've seen in the NASDAQ as far as consolidations go all of 2023. Here's that Thursday with, this is where we had the key reversal day for the S&P 500. Recall that in June, like mid-June, we saw profit taking in the mega caps and in the mega cap heavy sectors. Now we're also seeing some trend lines break in those same sectors. So here's a 60-minute chart of the technology sector. It is the most influential sector in the S&P 500, and you can see this uptrend line. If we take a little closer look on a 15-minute chart, we can see that price has been coming down below it. You could see where price has been respecting the trend line, jumping back above it, falling back below, hitting resistance over here. So to me, this is an important trend line, and we're seeing a lot of activity around it this week in the most important S&P sector. Another really mega cap heavy sector is consumer discretionary because you have Tesla and Amazon in that. Here is the 60-minute chart, and you can see the trend line, and you can also see that price has broken down below it. And we're going to jump to a 15-minute chart, and it looks, not only do we have like a break down below it, but we also have a bear flag over here. This is that Thursday, so we saw price kind of come down below it, but back inside on Friday. This is a really important sector as far as the mega caps go. And if we look at a 3C chart of this sector, you can see really good support, right? 3C is acting great, leading prices higher in May. We come into June, things start to change a little bit, negatively diverging, and in July we have a really clear negative divergence here. The other really mega cap heavy sector is communications because you have Facebook and Google in it. So if we zoom out, you can see this trend line, and if we zoom in a little bit, we did have a break below it, and we had almost what looked like a little bear flag forming over here. So this big jump back above, remember, it's earnings. So this is due to earnings from both Meta, which is former Facebook, and Alphabet, which is Google. Here's Meta or Meta, Facebook. Okay, here's that same trend line. Here's the break below it. There's the earnings, right? You can see how price is just respecting this trend line, whether support or resistance. Really interesting. And then Google, we'll go with the Class A. Google, we have an interesting pattern here, right? We have a bullish pattern here, a breakout, kind of a pullback to it, and this is earnings, so that gap up. If we look at Meta or Facebook, I'll just call it Facebook. If we look at their 3C chart, right, we saw some weakness coming in right over here into earnings, right? So I think they surprised. Here's the gap up on earnings, and we start to see 3C start to move. But this is negatively divergent. These two stocks are the reason out of the three mega cap heavy sectors that only one of them jumped back above the trend line. And that is the communication sector. So both of their earnings did this. But the other two mega cap heavy sectors are starting to break down below those trend lines. We still do have some leading groups that are still pretty strong, like semiconductors, right? So I'm going to pull up the Philly Semiconductor Index. Notice we have a similar trend line, bull flag over here. And let's take a closer look. And notice how price is respecting it, right? Over here, support, a little dip below it, back above. But what is interesting here is this resistance, which is, I would say, around 38.50 to 38.60 in there. So that is something you really want to watch on semiconductors, because semiconductors tend to lead the tech sector. While we're talking about semiconductors, I want to show you one of them, their earnings, and what I wrote about that. And what you're looking at is a portion of what I do pretty much every night for my subscribers, the daily wrap after the market close. And this is a section of it talking about Taiwan Semi, which beat on earnings, right? By the way, this is July 20th, the daily wrap from July 20th. But they issued warning guidance. And what I have been saying all along is that earnings are important, but what the market is really going to be looking at is guidance. So Taiwan Semi is the sole provider of chips to NVIDIA, and they're the main provider to Apple, Qualcomm, and AMD. This is what their chairman had to say. The short-term frenzy about the AI demand definitely cannot extrapolate for the long term. Neither can we predict the near future, meaning next year, how the sudden demand will continue or flatten out. The gist of, and this is what I'm talking about, something else I had written about earlier, the gist of what I had said yesterday about Apple's initial reaction to some AI news. It jumped and then just came back down. And AI has been like such a big narrative. So to see Apple talk about it, price jump, and then come back down, it was a little bit of a change in character. The next day we get this from Taiwan Semi. And all of that is just to say, watch this area of resistance in the semiconductor index. If it breaks out, great, then it's a good omen for the tech sector. If it cannot break out above this and it breaks down below the trend line, we know we're going to have more trouble ahead. You know, it is earnings season, so the day-to-day news or the day-to-day earnings is going to do stuff like this, where we do get breaks below important trend lines in important sectors like communications, and then we get an earnings report and price jumps back above. That stuff's going to happen a lot in earnings season. But what we do want to watch is how these trends are moving. Not just individual stocks, but trends. Speaking of which, while we're on the mega caps, I'm going to show you some 3C trends that we've been seeing. Remember back in June, really mid-June to the end of June, we saw at least what I would consider some heavy profit taking from institutional investors in the mega caps. So here's a 3C trend chart, 5-minute chart. This has really tracked the rally really well from October of last year. We're looking at Tesla. We can see really good 3C confirmation moving with price, even above it, leading it. And then we get into June, July over here, and we start to see negative divergences. Seeing a lot of these in the mega caps. So another one like Amazon, same time frame. Amazon. There we go, Amazon, where we had good confirmation. And over here you can see a clear trend, a clear negative divergence. If I were to draw it in, you can see prices going up, 3C is trending down. And what is probably the most important stock to watch in the market, Apple. So same kind of thing, really good strength in 3C, and we've seen this all year in the mega caps. They have been exceptional in price action, in 3C charts. We come into mid-June right over here, and you can see the same thing happening. We're starting to see less and less support. Prices moving up, but there's less support from institutional money. I think they were taking profits and getting out of a lot of these stocks, or drastically reducing their exposure at the end of Q2, which is also the end of June. But look, the markets are, in my opinion right now, they're getting really frothy. So usually there's not going to be very many bears left, by the time a market actually turns, right? And when you get to a bottom after a bear market, there's going to be very few people who are bullish. And I can see that kind of really frothy sentiment in indicators or in correlations that used to hold up really well that are breaking down. So to make this a little easier, what I'm going to do is I have this S&P 500 chart in the candlesticks, and then I put IEF, which is a 7 to 10 year bond fund. Remember that bond yields move opposite of bond prices, and what we've seen is a really strong correlation between bond yields, actually an inverse or negative correlation between bond yields and stocks, right? We can see it start right here at all-time highs back in, that was December of 2021, negatively diverging. That means yields are starting to move higher, right? Again, we get a decent little bounce over here. I think this is where we had that bull flag that failed, but yields are just skyrocketing right over here. So very strong correlations. Even over here, we can see that we get a little bounce because yields are giving stocks a little break. We get a bounce over here again, negatively divergent, right? Now I'm going to zoom in a little bit closer. So same exact chart, S&P with IEF in blue, but I've just taken it from the October lows where this rally started, right? And you can see pretty decent correlation. When you get a divergence here, you can see yields are moving higher right here. This is bonds moving lower. S&P pulls back, right? Pretty good correlation right up until the point, and this is exactly where I said it would happen, 4,200. When S&P breaks above 4,200, that changes everything. And you can see a huge negative divergence. So this is equity buyers just not caring about what yields are doing like they did for the last year and a half or so. Now, why was 4,200 such an important level? Well, first of all, we had like almost 2 months of earnings where price just could not get above it. And I said, if we do get above 4,200, if we get a close above 4,200, which I expected, we're going to see a lot of short covering. We're going to see a lot of people that did not believe this rally in complete FOMO, right? Chasing prices higher. You're going to hear all of these bullish narratives come out of the woodwork, which we've heard, the AI narrative, the soft landing narrative, the no recession narrative. But to kick it off, short covering was a big part of it. So let me show you what happened at 4,200, close above 4,200 as far as shorts go. This is a chart of the commitment of traders for S&P futures, the non-commercial. So this is speculators, basically think hedge funds, right? This was the biggest short position in S&P futures in the history of this data series. What happened right after the S&P closed above 4,200? Short covering. So we can see massive short covering. Short covering is buying, and that pushes prices higher. So you're getting a lot of bears too that are flipping to the bull side. Mass psychology is really interesting, and the market is the place to observe it. So here's a look at investor sentiment, U.S. investor sentiment, the percentage bull-bear spread, right? Recently hit the highest level, actually higher than it was at the all-time record highs back here in November of 2021 and then December of 2021. So sentiment is extremely bullish, extremely frothy. The fear and greed index is showing the same thing. In extreme greed, we've been up there around 82 right now, 78, but still extreme greed. And what happens is when sentiment is at extremes, like extreme greed or extreme fear, more often than not, it is a contrarian indicator. So we're looking at the very same indicator just over time, right? So this is where we recently hit on July 21st, extreme greed at 83. So we're just going to look at a couple other ones. This is August 16th of 2022. We hit 68, which is in greed territory. Get a 17% pullback in the S&P. December 1 of 22, it hits 76. We get a 7.25% pullback in the S&P. Here is February of 2023. It hits 82. We get a 7.75% pullback in the S&P. The point is, it's not that we're going to get a 7.25 pullback or 17%. That's not the point. The point is mass psychology, mass sentiment, and when it gets to extremes, that it is more often than not contrarian. And speaking of frenzy, don't forget about what I just showed you, the chairman of Taiwan Semiconductor talking about the whole AI thing, right? The short-term frenzy about the AI demand. And to bring this full circle, this is just to come back to why correlations are breaking down. Correlations that were so reliable that you could call pullbacks, you could call bounces, you could call intraday moves, and we've got a huge divergence between the S&P and yields right now. If we come back to this chart of the S&P and IEF, the 7 to 10 year bond fund, and remember that yields move opposite bond prices, that's the divergence I'm talking about, and it happened as soon as prices moved above 4,200 for all those reasons I just showed you. This to me is a market that is getting very frothy. But what I would encourage is to think a little bit outside the box, because most traders, I would say, think in terms of either I'm going to be long the market or I'm going to be short the market. And many like individual investors think in terms of I'm either going to be in the market or I'm going to be out of the market, like 401k contributions. So when the market's like going down, they don't want to contribute money to the 401ks. When it's going up, they do. What I'm going to say is don't think in those terms of extremes. The big money, institutional money, hedge funds, pension funds, all that, they have to be invested, okay? They don't have the luxury of saying, okay, I'm going to go all long or all short, or I'm going to get out of the market. They have to be invested. So sometimes they're looking for the best place to make money, and sometimes they're just looking for a port that they can weather the storm. That's the great thing about being an individual investor trader, is that we're not constrained by those things. The reason I bring that up is because we are seeing some changes in tone in the market. S&P 500 hourly chart, and this is my own equal-weighted index of defensive assets, defensive stocks. Here's the all-time high, and you can see as the market starts to come down, what do we see? We see investors pile into the defensives. Now, many of them are also bond proxies, so as yields rose because of inflation, because of the Fed hiking rates, those stocks also got hammered. But what we can see is they perform okay with the S&P as this rally starts in October, but Everybody's going for the mega caps. They're going for the cyclicals. The defensive stocks aren't that interesting to them. They want to be in the stuff that's high flying, right? Why would you move into defensive stocks? If you had the opinion that the economy and the market were suddenly going to start making a turn. Or not suddenly, but start making a turn. These big funds take a while to move. They don't do it in a day. They can't do it in an hour like we can with trades. It takes them weeks. Now here we are on a 5-minute chart of the exact same thing, right? And I showed you how these were not performing well. They weren't in favor at all. Look what happens over here very recently. A lot of times what we'll see is changes in the market or market leadership at the end of a quarter or the start of a new quarter. But because we had earnings season starting in mid-July and we had the Fed, my call was that we might not see that. We might see the market kind of wait out earnings. And actually, more importantly, guidance. But interestingly, we're seeing some moves in defensive stocks right now. So you've got the S&P at an all-time or a 52-week new high, right? And all of a sudden, we're seeing movement in defensives. I can tell you who that isn't. That is not your everyday day trader. If you are a subscriber, I did a post about a week and a half ago, I think, talking about defensive specifically, and some really big changes in character that are way more than what we see right here. And then, of course, Friday, I put out another post on a very specific sector, but seeing a change in tone there. My macro outlook is largely the same. Okay, so my macro outlook has been that because of the lagged effect of monetary policy, that towards the second half of this year, we're going to see the economy start to deteriorate more, and that is going to affect stock prices at some point. We're not there quite yet. As you can see, stocks are still ripping higher. And I'm not going to get into the whole, my reasoning, because I've done that in all my videos, but I do want to show you a few things, examples of why monetary policy lags. And in just about all my videos, I've said, in my experience over 25 years, I think it lags by about a year. Okay, now the Fed, I've seen Fed papers that say monetary policy lags by 18 to 24 months. That means if the Fed hikes rates last week or this week, you're not going to see that in the real economy for 18 to 24 months. In one of my recent videos, I was talking about in like Q2, the economy's basically, with that 12-month lag, experiencing like a 1% Fed funds rate, but that's about to go vertical because this is about the time when the Fed starts moving from the 25 to the 50 to the 75 basis point hikes and gets real aggressive. So this week I saw this text shared, and this guy is an owner of about 10 strip malls, right? Not huge. First commercial came due today, went from 3.75 to 7.25%. Renewal or payoff, my payment went up $3,000 per month on a $1.5 million note, $36,000 a year less in cash flow. Now that is just one example of one person. Now he can pass that on to his renters, right? And they may pass it on to their customers. But this is the lagged effect. This is one example of the lagged effect. This is one of my daily wrap posts for my subscribers, and I talked about the advanced Q2 GDP report that came in stronger than expected, came in at 2.4%, where consensus was like 1.6 to 1.8, and Q1 was 2%, right? But in it, consumer spending slowed considerably from 4.2% down to 1.6%. What made up for it? Government spending. So I go on to talk about the slowdown in consumer spending. It seems to fit with the data that we're seeing, the consumer data, in stuff like credit card debt, right? Loan applications and loan rejection data. Q1 credit card balances grew at the fastest rate in 20 years. The cost of revolving credit has hit multi-decade highs. Here's an example of that. Credit card interest rate. This, by the way, is November 1994. Credit card interest rate, revolving credit. Look at this. What has happened here? You think consumers aren't feeling this? It's already showing up in the GDP data. We got the 25 basis point hike from the Fed. Really not much reaction to the Fed at all. But Powell did say that the Fed is no longer forecasting a recession, because in the SEP, Summary of Economic Projections of the prior Fed meeting, the Fed staff was forecasting a recession to start in Q4 of this year and into Q1 of 2024. Let me show you something really interesting from the New York Fed's own website. This is the New York Fed's own recession gauge, okay? Look at the level that it's at right now. All these little areas are recession. That's the COVID crash. This is the great financial crisis. This is the dot-com bubble. Okay, so look at how high this is, going all the way back to like 1980, the early 1980s, 4 decades. It is the highest in 4 decades. This is the New York Fed's own recession indicator. And if you spent any time at all looking at the history of yield curves, you would have to really be a believer in this time is different. This is the 10-year minus 3-month yield curve. I usually use the 2-10 spread, and the only reason I didn't here is because the Fed itself released a study and they said that they think the 3-month 10-year is more accurate. So when the yield curve inverts, which is below this dark black line over here, and again, these are recessions, that is the warning of recession. I believe since World War II, every recession in the U.S. has been preceded by a yield curve inversion. Yield curve inversion here. So we have the dot-com bubble, we have the great financial crisis. It even happened before the whole COVID lockdown thing. Look at how deeply we are inverted here. You can go all the way back 4 decades, most deeply inverted in 4 decades. You think this time is different. There's not going to be a recession this time. Happened every other time. It's not going to happen this time. Now, to be fair, the inversion is the warning. It is the sharp steepening right after that tells you a recession is imminent. What that sharp steepening usually is the Fed already cutting short-term interest rates because they can see the economy's in trouble. The Fed has basically exchanged a recession to defeat inflation. So I don't think we're going to see that sharp yield curve steepening unless we're just seeing it from the market, where the market is driving down short-term rates because it's seeing a recession and it's saying, okay, long-term rates can stay where they are because we think, in 5-10 years, we're not going to have a recession. But that's the yield curve steepening. I don't know if we see it this time like we have before. It's been 4 decades since we've had this kind of a scenario. But the point is, you're this inverted, the probabilities that this time is different are very, very, very low. And part of the reason I came up with my macro outlook forecast, expecting that we're moving into recessionary conditions the second half of 2023, has a lot to do with when the yield curve inverts and then when we get an actual recession, that amount of time, which has to take into consideration the lagged effect also of monetary policy. So I'm not calling for a market crash or anything right now. We're still in a bullish trend, but there are some definite things you want to be watching, like that key reversal day in the S&P 500, what's going on with the NASDAQ 100, what's going on with the mega cap heavy sectors, and do we continue to see inflows into these more defensive areas? And they're not just stocks. If we do, that is telling me that institutional money is preparing for recessionary conditions by moving into the more defensive things that hold up better during a recession. So in the short term, we'll have to see what price action actually does. If we do see a toppy formation in the NASDAQ, like it appears we might be seeing the start of, then we can get a measured move. We can kind of gauge where that would come to on a pullback. But in terms of once we get into a recession, God knows what is actually going to break. The Fed always breaks something on every rate hike cycle. Longer term, I would say over the next year, my forecast is that we will be back in a primary downtrend bear market. Not yet, but I do believe we will actually see that. And there's some great ways to make money in a bear market, but we'll get to that when we get to that. First, we are in a really frothy market, but we're still in an uptrend. So there's a lot of things I didn't cover. Small caps, Dow Transport's fabulous price action, the cyclical sectors, the 3C charts, what's going on with VIX, volatility signals, really interesting stuff going on there, market breadth, a whole lot more. That's all for subscribers. You can still subscribe at 2008 rates at wolfonwallstreettrade.com, and we are going to be moving to the new website very soon. That's the technicaltake.net. You can take a look at it.